Hey folks, Tom Norfleet with www.citizenshipquickly.com. We specialize in showing people how to get their taxes to zero, close to zero. We started off years ago going domestically and then went internationally. Internationally is a lot better. You have to make a lot of drastic changes to go internationally and get your taxes to zero or close to zero. You can look at our videos and tell more on that. But today I'm going to talk to you about dollar cost averaging. Dollar cost averaging is a simple concept. I actually learned this back in the early 1980s when I got in the financial service business, when I was a financial advisor, which I'm not now. But one of the things that I learned at the very beginning was dollar cost averaging. And what this does is it allows you to invest any particular time. You don't have to worry about if the market's high or low. Because that's really a guesstimate. Even when the market plummets, you don't know how far it's going to drop before it bottoms out. And for you to try to find out where the bottom is to invest a lot of money at one time, it's a guessing game. The best investors can't do it. I mean, they've tried doing it. Best market. John Templeton used to say the best market timers in the world can't get the bottom of the market, so why would you try to do it? Now, I will show you almost a sure way to get some of the money in the bottom is by dollar cost averaging. And by doing this, what you're doing is you're taking the same amount of money every single month, which you can raise if you want. Let's say, for instance, you have around 24,000 US dollars that you want to invest in a lump sum. Well, instead of trying to find out where the bottom is, you're better off just taking that 24,000 and if you want to, let's say, spread it out over 2 years to invest all that money at one time, instead of doing it at one time, is to spread it out over 24 months, which would be 1,000 US dollars a month. So you're putting in $1,000 a month every single month, and what you're doing is you're buying some of the stock or mutual fund, whatever you're buying. You're better off doing it with some sort of fund, and I would not go in a mutual fund. I think you're better off picking an index fund. Your fees are a lot lower. Index funds some of them don't even have little to no fees, depending on which group you go through. What's happening now? I haven't checked this out, but I heard that Fidelity just came out with an S&P 500 index fund that has 0% management fees. And you wonder, I haven't seen this. I heard they were coming out with it. You could check with them to see on this, but I know that they've got a fund now that has that they were going to come out with. I don't know if they've come out with it yet, but it has no fees at all. Now, how do they make money? Well, basically, they're hoping that, I guess, you'll put money in cash accounts and they'll reinvest that and get higher rates than what you're getting there. And also they're hoping maybe you'll go in some of the other funds that they have. These fund companies traditionally don't lose money on clients. Some do. Some clients they do lose money, some clients they don't. But who cares as long as you're making money on it? These are the type of things you should be looking for. Try to get your fees as low as possible. If you can get it to zero, that's great. But what you need to do is, if you're investing the same amount of money every month, let's say, for instance, an index fund is selling it at 100 a share, and you're putting in, let's say, you're investing $200 at a time every month, then you're able to get 2 shares if you're investing, because if you're investing $200 and the share price is $100, then you can buy 2 shares. If the share price drops down to $50 a share, you can buy 4 shares. So as it continues to drop, if it goes all the way down to $2 a share, you can get 200 divided by 2, which is 100 shares. So you can see that the further it drops, the more money the more shares that you end up buying. And if you look at a chart, and you look at a chart that goes like in a V formation like this, and it comes right back to where it was, you'll actually, on the accumulation of shares, you'll make more money where a market is starting off here, goes down and comes right back to where it started, if you're dollar cost averaging, than a market that starts off down and goes continuously up where it has no drops, because you're able to buy a lot more shares as the market's fallen, and you'll get a lot more shares at the end of the actual investment cycle in that V formation than you would as far as the market going straight up. You would think you'd have more money with the market going straight up, but you don't. You actually have more shares and more money on a V formation. And so that's why you want to hit the highs and you want to hit the lows in the market, and you're almost guaranteed to get some in the low part of the market if you invest every single month. And you're better off trying to do this than trying to pick a point. Even if you think the bear market, a lot of people will say, why not go in when you have a bear market approximately every 6 years. We're in a long bull market run right now, but probably the longest in history, in my lifetime anyway. So we've got a bear market coming up pretty soon. But why not go at the bottom of the bear market? The problem is you don't know where that bear market's going to end. You might say, well, the average bear market ends usually from the peak to the bottom is about 33%. That's traditionally about the average bear market drop. But our last bear market it started in about October of 2007 and ended in March of 2009. And during that time period, the S&P 500 dropped around 55% from the high to the low. So that's a lot bigger. That's the worst bear market we've had actually in my lifetime. Only the one that was worse before that in the last 100 years was the Great Depression. It dropped about 85%. So it's very hard to pick where the bottom is. And a lot of times people say they're going to invest in the bottom and they don't because it gets too scared. It's too negative. The news is real negative on TV. So they end up just not doing anything. So like I say, what you're better off doing is dollar cost averaging. If you want to raise that amount from $1,000 a month that you're invested to $2,000 a month, then you need to keep it the same amount. Okay? Don't try to vary the amount that you're putting in and trying to pick where the highs and the lows are. Just keep the same amount of money you're putting in every single month. And like I say, it's a lot easier to do this with funds, index funds, versus stocks, because some stocks, when you dollar cost average, they never come back. Some of them drop down and you don't see them come back. They go bankrupt or they stay down for years and years and years. Goodyear is a good example of that. Goodyear Tire. There are loads of companies that drop 90% that stay down, became penny stocks. And they never come, they might not go bankrupt, but they never come back up again. If you deal with index funds, what happens is if a stock falls off an index, there'll have to be an automatic replacement for that stock. And all you're doing is you're not worrying about switching equities. You're going in the same fund and you're just putting in the same amount of money every single month. And that's the easiest, smartest way long-term investing, because you don't have to predict the highs and the lows of the market. But traditionally, you will do better dollar cost averaging than you will trying to pick lump sum investments, lump sum time periods. Like for instance, if you try to pick when the market drops 25% from the high to the low, and they've taken cash that you've saved for 6 years and then try to plummet it all in at one time, I'm going to tell you, typically you will end up with less money doing that method than dollar cost averaging and just hitting every single month. And plus you work on a fear factor when you do that, because when it drops a tremendous amount, to get the nerve to throw a ton of money in at one time, it's very difficult to do it. You'll say you'll do it, but people won't do it. That's why I say you need to do it automatically. You need to have it set up on a forced savings program where you have a bank or a mutual fund company or index fund company to actually, or company that does a lot of index funds like Vanguard Group. Fidelity is a good group to do with, and then dollar cost average it. And then what you do, you hit the highs and then you hit the lows of the market. But long term, the market goes up. That's one thing that you will see. Even during the Great Depression, the market came back. It took about 27 years for it to get back to where it was. But the point is it came back. And you missed a lot of opportunities if you didn't buy at that real bottom when the stock market plummeted out back around 1932. That was about the bottom of the Great Depression. It took about 3 years for the stock market to drop, and it dropped around 85% from the high to the low. So you would have saw your money really plummet, but if you'd continued to invest during that period, your money would have grown tremendously when it came out of the Great Depression and the bottoming out from 1932. Anyway, if you got a question or comment, just put it below. And also, if you want to subscribe to new videos, just hit the subscribe button below and we'll get them out to you as soon as they come in. Also, if you want to get your taxes to zero, look at our website, look at our videos. You can get some good pointers that you won't see anymore on other websites dealing with this. We have tons of free videos. If you got a comment, just put that there and I'll see what I can do to help you. And good luck to you, and I'll look forward to talking to you on the next video. Take care. Bye.